And I'm going to speak to you this afternoon about financial modeling. Well, it's not going to be a masterclass in the classical sense of the word, because we're not going to create a financial model on our lap. What I will try and do over the next hour is to share as much information as I can, and then follow up by answering any questions. And the way this masterclass is structured is that I'm going to talk to you about how a startup in its early days should go about creating a financial model, because this is indeed, it's a big challenge facing startups, how to even begin to approach this. Many download a template and then fill them in and then throw them at investors who complain, but they can hardly do anything about it, because it's very hard to teach a startup to produce a financial model. It's not the job of an investor to teach them how to do it right. So we're going to talk about how to go about planning at an early stage, and what really matters, and what a financial model is all about. Why have one? Why create one? The purpose of financial model is it's not for the investor per se. We create a financial model for ourselves, because whenever you create a financial model, you work through any vulnerabilities of your idea, of your project. And the job of the startup team is not just to create a spreadsheet in Excel. The job of your team is to put your heads together and create it as a product of a teamwork, and then keep it updated, and also do a sufficient amount of debriefing whenever you encounter investors, and then you go back to the drawing board and update your model, because your average investors don't expect your financial model to be 100% reliable. That everyone appreciates that any model is based on assumptions, and this is a learning curve. And as you hone and polish your financial model, then you, based on any information, that you make it better with every iteration. So what is the purpose of financial model? You need to have a goal as a team, as the founders of your startup. Why is it you're doing what you're doing? And that sense of purpose should be measurable. To some, it's $1 million. It's a good goal, actually. You always need to proceed from certain assumptions. Basically, anything that lends itself to being measured is something that needs to motivate you, because to put 3 to 5 years of your life into working 24/7 to build a startup, this is hard work. This is actually very intensive. It will have very huge demands on your time and your energy, and you've got to learn to communicate that to an investor through your financial model. Why it is you're doing what you're doing, and what your financial model needs to show, among other things, is some of the tools that you're going to use in order to get the message across to your customers. Do not plan marketing using sheer numbers. Any marketing should always be very strongly rooted in your key metrics that you then equip your marketing people with, those who will be promoting your product, and you brief them on in terms of what they need to do, what it is you want to achieve. Okay, speaking about your market, market overview is indeed a very critical element of your pitch, but your financial model should chart a way, a road for you to get into the market that you wish to sell to. So, but this is what your financial model is expected to give some answers to. In terms of operations, how are you going to keep an office? How are you going to pay your people? Are you going to travel to meet with customers? With lots of important details. where the devil resides, as we all know. And in principle, any financial model relies on a hypothesis, multiple hypotheses, and you've got to have those hypotheses documented, because in a year's time you will no longer remember what assumptions the original financial model was based upon, and you need to record your thoughts with your team just to measure your current position, and when you're pitching your project to an investor, you've got to put the whole story in front of them, and then they ask you why. Okay, when you've got your hypotheses at your fingertips, and it's actually something that helps you deliver a more compelling story. Transparency. From what I've seen, I've come across financial models being delivered to me in PDF format, or those that do not contain any formulas at all. I would like to very strongly advise against that. This is bad manners, in fact. It's actually. Do you have anything to hide? How you came up with a number? How you computed a certain value? You should share your financial model in so that to give an insight to the analysts on that side, to try and figure out how you go about the calculations. It's not that the fund manager is going to do this. It's going to be pawned off to some analysts who are going to peruse your financial model, and they shouldn't find anything wrong with, if you when you make assumptions about revenue growth, about growth of your clientele, what you've got to bear in mind that you've got to keep up those client relationships, and you need to keep up the growth that you are projecting. Please bear in mind that before your top line grows, your costs will grow, your expenses are bound to grow. Even if you are benefiting from really very fantastic growth, but in some startups that maybe those may not grow in proportion, but you always have to validate your growth. How are you going to support that growth? And that kind of Nike swoosh kind of shape, how you grow, and but then you've sold your app and clients have downloaded it, and it's not working, or they're not getting sufficient support because you haven't invested in your support function, in a help desk, and then this is when this whole thing sort of rolls back, and sometimes you lose those clients for good. They never come back, and that also needs to be reflected in your financial model. Whenever you're planning, okay, you've got one document owner, but if you are planning your marketing part, and you've got somebody responsible for marketing, you've got to sit down with them and work through the numbers. The same applies to the technical side. Your CTO should be consistently and prominently involved and throughout the planning cycle to avoid situations like some corporations, or most corporations normally encounter, with when budgeting is done at the top level and then it is forced down the throats of everyone else in the company who's below that level. But you've got to keep up a very high standard of transparency. Now, industry standards, I've come across, unfortunately, on many occasions, people haven't learned how to Google stuff. And I'm being serious. It's just a fact. It's just when people include like market data, and if I go and Google numbers and Crunchbase, some other resources, it's just like they give me the market size, and I check it and it's wrong. And that's what you need to. What's really great about working with a financial model, when you work to create and improve your financial model, you find so many answers to your own questions. And there's loads and loads of templates available online. You don't have to reinvent the wheel. Don't waste time on this. What are some of the common mistakes about your hypotheses? People fail to document them. Commit any assumptions to paper, any product from your brainstorming sessions. Document everything. Now, I've already addressed the issue of that for myself, like financial modeling over a span of 10 years. No, it's not viable. Okay, 3 years max. If this is a big hardware-related project, okay, 5 years would be your planning horizon. But at the same time, avoid the other extreme of keeping your planning horizon too short, because you need to be able to demonstrate when it is that you are planning to start growing or achieving a break even. Everyone expects losses in the first year or two, but you need to include within your financial model your expected break-even point and the sustainable growth going forward. Because what a potential investor wants to see, they want a healthy return. Yes, maybe at the next round, maybe the exit strategy is an IPO, but they're not just buying a piece of a company because they have nothing better to do with their time. But you need to try and demonstrate how you're going to manage your growth and how you're going to scale up your operation. Now, it may sound something funny, but some people make a very weird choice of currency. If you're targeting the US market, you'd better compute your financial model in the US dollar. And if you are targeting China, well, you can go with the dollar. That is something that you can solve. But some people now have, out of Ukraine, they've done their modeling in the hryvnia. But if you are going to pitch to Chinese investors, you've got to learn to speak the same language, and even currency is also a language. And the same applies to pitching to somewhere in continental Europe, where you have to use the euro. Now, let's move on to the meat and potatoes part of the document itself. So you've got to keep it as transparent and clear to read as possible. Now, yeah, certainly, MS Excel is where it is probably the easiest tool, or Google Sheets. Google Sheets is better in some respects because it is easily shareable, and you don't have to build very complex formulas because you're not a big corporation at the end of the day. You need to keep it simple and stupid and easy to understand, and it better fit in one page, 3 years, and you should have those additional sheets, maybe, and then you need to have dedicated sheets for your marketing plan, for your revenue and expense, your P&L, and then graphs. You need to pick a maximum of 4 metrics, and those are the most critical metrics for your particular startup. And then you calculate them, and then you create graphs. And then this is your page deck. If you just pick just one metric, revenue or net earnings, and that's it. That's not enough. You need to do more. Now, P&L. Now, this is what a financial model looks like for a startup. This is just certainly a template, an example that I'm just showing you for the purpose of training. So the point is just to look at your financial model, take kind of a bird's view, kind of look at it without too much detail. So you basically freeze these columns, and then you can scroll right to get to the next year, to the next periods, basically. And this is how it is made up of your revenue and your cost of sales and your gross profit and your overhead and your net earnings. So why this structure? Because actually you have a dedicated sheet for your sales. Did it bring it? No, it's back. Okay, good. So your job is to itemize these headings in additional sheets. If anyone is interested, then they just navigate to the right sheet, and they don't have to ask any other questions. Now, payroll. The recommended approach is to benchmark salaries with the going competitive market rates. Okay, you may begin by not paying people a competitive salary in the first year, but no one is going to work for you for free. Maybe or the founders can still survive on their own sort of resources, but you can't expect people that you hire to work for free. That is a common mistake when startups create financial models. They just go like salary of $300 per month for somebody, and they continue making those assumptions going forward. They would continue paying those unreasonable salaries. It's just you don't want good quality people. You want best quality people. This is what you're selling to your investor. We have a great team. We're going to bring this product to market very quickly, but no one is going to give you their best performance for $300 a month. You need to, and in particular now, the market for developers is overheated. If you look at the list of developers and you look at the salaries, and that's what you factor into your model. Now, you project your payroll throughout your entire planning horizon, and you need to think about rewarding them potentially with stock options. It's important not just to have those people around when you launch, but you need to plan for retaining your talent, and that will necessarily require that you think about increasing your salaries over that or your planning period, say 10% plus. Stock options, other fringe benefits and perks, because your key R&D personnel, if it is an IT product, this is expensive talent, and it's not that you have to pay them high salaries, but they are like a very hot commodity that people will be struggling to hire away from you. Well, this 10% on an annualized basis. Look, it depends on your industry. Look, it's not if you wish to increase your salaries by a higher percentage. It's your call entirely, but it's. Look, in terms of structure, the payroll sheet, how it is built. Okay, you have your R&D people separately from your general and admin personnel. One important, like your CEO and other top executives, should not be included within your R&D. You shouldn't have your roles mixed up, or apart from your sort of chief marketing officer, whose salary goes into your sales and marketing, but everyone else is your general and administrative personnel. Because whenever an investor looks at your cost budget, so the question that comes up, okay, your executive level, yes, those chief officers, they will certainly expect quite high salaries, but your payroll sheet should be internally balanced. It just needs to make sense. Now, revenues. This is one marketplace and a SaaS project, and each has its own peculiar features. So you will be doing the maths for each of those, certainly based on your own assumptions. But your top line projections should be based on a very in-depth understanding of your client base, in terms of, okay, like not just a ballpark number of 100,000, but okay, what your total customer acquisition is expected to be, and this sort of churn rate, because never supposed to expect to retain 100% of clients you've acquired. And then it's like returns and allowances, and your metrics should be consistent with and should be very specific to your project. So you can look up metrics, standard metrics for a SaaS project, for a hardware project. There's loads of information, mainly in English, where you can, like 10 key metrics for this type of project. That is easily Googleable. Now, the marketplace project. So there's this average order fee, month-over-month growth, churn rate, and for a SaaS project, there's a smaller number of metrics available for you to choose from. You don't have to run 10 or a dozen metrics. 5 should suffice initially, because you will need anyway when you sort of meet with reality. So you will have to have a way of getting a sense of what's actually going on, and the financial model is it's numbers. This is your assumptions translated into the language of numbers. And if we expected 375 new clients, but we only ended up with 200, what's the problem? Can we catch up, or is your churn rate higher or lower than you initially anticipated? Then its measurability holds the key to motivation. When you have a way of measuring something, in particular when you measure your past performance and you analyze this and you gain an insight into what might have gone wrong, then you're not sailing blindly. Now, your cost budget. So you need an infrastructure of some sort, and you need to pay for your infrastructure, for any services that you need, for any software that you may need. Your R&D. It's an important piece that essentially lies at the very core of your project. Now, marketing expenses. Yeah, it's like in broad strokes, because there are so many methods to how you do marketing, but you need to itemize it. If you're planning to launch a Facebook page, a referral program, your marketing person should put it on paper, and you need to be prepared to speak about each and every sub-item of that heading. Yes, there is a fair amount of conjecture, because you are a startup in your early days. No one expects you to sign in blood or commit to anything completely conclusively, but you need to elicit and show the investor what the logic is behind your calculations, because it's basically whenever you play with your assumptions, you change an assumption and the whole model gets recalculated. You can work with multiple scenarios, best case scenario, worst case scenario. So what if we end up with a lower number of clients that we've acquired, so not 300 but 200? Do not be lazy, do not input numbers just without them being arrived at through some formulas, and it's always like in this case. Now we have those assumptions about our infrastructure, marketing, outlay, travel. You can either make it part of the financial model, or you can actually have it as a separate document, but you certainly should probably keep it as one document. Now your unit economics, that's what investors really love, because a professional investor, they make their decisions fast. They learn to read numbers very quickly. They're not an analyst. They don't have time to deep into your model. They ask questions expressed as models. What is your RPU? And it shouldn't basically put you off. So you need to know these terms. If any one of you has watched Shark Tank, the US too, that is probably the coolest show there is for a startup. I watched everything, and they're still shooting. It's from the very first episode. Watch the show. Look at how people pitch their products to the sharks. What questions they've been asked, and it's why do many, or in fact most startups fail and get turned down by the sharks, and you will see situations people that get, for instance, they get too nervous. They do not get an investment because they simply get stalled over a question or something. And those are actually real cases, and those were the real pitches, and many of them succeed in attracting an investment. So unit economics, it's basically is what you need to learn when you learn to pitch your project, and you need to learn to sail in those choppy waters. I've picked several metrics that are very common. So I'm not going to give you the formulas. You can Google them on your own time. But actually, what is important? Okay, lifetime value, your average revenue per user, and this is something that it often gets asked, and you've got to have those numbers handy. So, well, that what always gets asked is your customer acquisition cost, because your entire business will depend on how expensive it becomes for you when you acquire a client. So if you, and there is this normal rate of defection. It's because some clients will leave, but you need to achieve a critical mass, and this is a big risk to an investor if they see that you're acquiring clients, but you are paying too dearly for that. Then the investor will probably pass on you. Now, you need to try and analyze why. Look, but it's not the job of the investor. It's not their job to figure that out for you. You've got to be prepared to meet the question. Now, customer retention. It's basically how good you are at retaining clients once they've been acquired. Okay, now it's in your early days, and you're only thinking about, you're making assumptions about the strategy about customer retention. You're building your hypotheses, and when you build those assumptions, one thing, but when you start selling, then you need to keep an eye on your metrics, how they are behaving. And in principle, okay, we will be talking about this tomorrow when discussing fundraising. I'm going to address this in my tomorrow's talk about how an investor makes a decision. But what really matters here is that when you are calculating these numbers and you know what to focus on, how to work with these ratios, and if you realize that your ratio is not very pretty or appealing for your investor base, one painful thing you can discover that your acquisition costs are too high, then look at competition, do some benchmarking, analyze their approach to selling. If you go to Crunchbase and you can look up at your competition, like you can monitor things like how many times the competitor app has been downloaded, and if you can do that kind of benchmarking, so you do not project for slow growth. If you are assuming that you are going to grow at a slower pace against competition, then this begs the question, why invest in you? Why not switch gears and invest in your competitor, which is growing so much faster? And that's got to be reflected and understood through your financial model to achieve a rate of growth consistent or higher than your competitors. And this Excel spreadsheet gives you those answers. Now, moving on to charts. This one has 6 bar charts. This is a marketplace financial model. What this shows, okay, you show your number of active users per month. Now, your key ratios, your P&L, and your key cost drivers, R&D, marketing, and general, and your total sales. It's really crucial for a marketplace project. Now, as a separate sheet, you can show your key unit metrics, at least a couple of those metrics, because when you're pitching, you have a very short time slot. You need to hook those investors, and if you send your pitch to a fund, they get dozens or if not hundreds of those pitches per day, and your numbers should be easily read and understood. So your key ratios are your good friends. They actually gain interest. They rivet attention, and investors also tend to specialize. If it is an investor investing in web tech or hardware, they know what a good picture would look like, and this gives you a quick answer. And then if they ask a question, there is something wrong, and then you can quickly answer the questions. Maybe then it's not the right fit for you. It's not the right type of investor for you. But you can normally, even if you respond with follow-up questions, they will probably not answer at all. But it's important to solicit and process feedback from investors. Now let's move on to some additional slides. What is also important in your pitch deck and in your financial model is how you are going to use the proceeds. This is what your financial model should, if you are seeking investment of 500,000 to invest it in marketing because you're entering a growth phase and you think you know how to expand your business, how to increase your clientele. That is your perfect picture, and you need to demonstrate to an investor how you're going to appropriate the investment. So then the next question is that of valuation. How to put a value in a company? We're not making any money. How much is the company worth? This is actually possible even for an early stage startup. It's just that if you have any revenue at all, if you're making earnings already, so that is good, because you can put a value set, a multiple, and that is sort of unassailable. It's only a matter of how big or small that multiple will be. But you're deeply rooted in hard numbers, because if you've made sales, it means that this is your past proof of concept kind of period, that you're showing already that you are growing. But if it is a pre-revenue startup, valuation is more of an art than a science. And when you sit down to talk to an investor, it's just that whatever the investor tells you your company is worth, that's what you take. Okay, if you get 3 term sheets, and based on this, you then make your decision. Now, there are methods that people have used to put a value in a startup at an early stage. That's what I'm going to talk to you about. 4 methods. The Berkus method, actual cost, some scoring, and risk factor based. So the Berkus method is pretty simple. Is that each item is given a maximum of 500,000. Your basic idea, your prototype, if any, your management team, strategic partner, if any products launched, any sales made. Now, then again, it's more of an art than a science. You are putting a value on yourself by these measures. So, and that is what an investor will be doing, because they use a pretty similar toolkit. They may have their own assumptions, but each of those items, this is what really matters to a startup in its early days. It's when you have this, and when you work through your numbers, then certainly your value is to be expected to grow. Now, the total cost method is basically you add up all your costs that you've incurred, or you can also do some sort of a benchmarking valuation. But then again, when you pick your benchmark, then investors may not agree with that other company actually fitting your particular case. Whenever you are doing your own valuation, you should employ as many methods as possible, because the more accurate, or the better you understand how much you're worth. It's not just you're picking a number out of thin air. It's like, okay, I'm worth $1 million, but this is we're worth $1 million, and here's why. Because this is one method, this is second method, this is the sort of the band. So the minimum would be the total cost approach, and the maximum valuation would be produced by those other methods. The scoring method, a risk factor based on that. The scoring method is quite a long one. It's not the whole table I'm going to show you. And this is basically a big questionnaire. And you answer those questions, and when you are scoring yourself, you actually, this is a very useful exercise, because this is a self-assessment. This is you identify any vulnerabilities that you need to improve on to present a stronger case to an investor. Okay, your team. If a big value is assigned to industry experience, and if you are not very good, so then the question is to the composition of your team, how much each member adds value to your team. Now, another important metric is whether you're willing to step down to allow a competent CEO to take over. This actually is something, it's whenever, well, it's in most cases the founder acting as CEO, they may not be very good at being a CEO. Then the investor asks that a more experienced person be picked, and it's important for the founder to learn to live with it, because the founder continues owning the business or co-owning the business, and they've got to learn to evaluate themselves critically, and it's an important step when the founder, with the entire team of founders, commits to learning also from their investors, as their mentors. So, and then again, your team should better be larger than just your founder, which is the case with many startups. But in most cases, investors are, apprehensive when they come across a startup with just one founder. There's this buzz factor. Okay, if you get hit by a car tomorrow, what happens next? So this is you are selling to an investor, and venture business is high risk by definition. And then there's a one-man show who wants you to invest in them, and then everyone else is just hired employees. They can just jump ship tomorrow. But it's certainly good to have a team of at least 3: a strategist, CEO, a CTO, and a third person, mostly somebody doing sales, doing promotion, understanding how to promote the business. That is your dream team. And what would be their respective shares? Well, it's certainly your call. It's up to you, and it's negotiable. Your individual shares will certainly depend on the input from each person in creating the startup in the first place. Look, there is no perfect model. Well, you should steer clear of 50-50. If you have two founders, it is an impasse in the making. So you've got to have somebody in control, somebody who's in charge of strategy, one person who... It's really important for a startup what value each person adds, what they bring to the table. And if that person does not add any value, then this is going to immediately raise the question from an investor: why is this person who has no value eligible to claim a piece of our earnings? But it's and a startup is not only a place where people, well, mostly they're all committed to, dedicated to that company, and it's actually a team, and a team is to be made up of people who support one another and have faith in one another. You can't really measure that using numbers. Well, sometimes it's just equal shares, or sometimes the first founder gets 40% and the other two get 30%. So if you have three founders, you can divide into three shares, and you don't have one single person. You should avoid this kind of impasse kind of situation when they lock horns and then they can't make any decision. But it's okay if you take on an investor, then you have this natural dilution of shares. But you're not creating your investor for an investor. That's how you began, and there were two of you at the very beginning. That's how you continue, and then. If she's not talking to the microphone, but I understand the question is, if you're pitching an investor, how much should you be prepared to give up to an initial investor? That's what I'm coming on to this. Okay, then again, we go back to how to put a value on your startup, and how much you're prepared to give up to invest. Okay, if the investor goes, I'm going to give you 100K and I want 10% of your company. Well, you can do the math very easily to arrive at how much value they're putting on your business. So that is the point. It's why I suggest that you run this exercise for yourselves. It's not like that you hire a surveyor to get your house appraised or something. This is your starting point for you to feel more confident when you sit down to negotiate. Okay, we know that we think we are worth $1 million, and we have something to show for it. Now, scoring. Market size, in this particular case, market size in terms of available market space, not the whole size of your market, which can be worth 35 trillion or whatever, but your specific market space. Now, any IP rights, or do you have them protected? So can you potentially protect your business against competition, to apply for a patent, or if not, then how are you going to expand in markets where you have very tough competition? You need to factor that in, and it's fine to speak about this openly. That one is that you are prepared to a licensing arrangement if you're ready to go down this path, even you are ready to sell to a competitor. If you're doing something that Nike could potentially be interested in, an M&A is fine. If you if you exit by selling that startup to a Nike, it's fine. You turn around and create another one, but it's like you need to explore the sort of the life cycles of IPOs, how they begin and how they exit. So if you have pre-revenue orders, this counts very strongly towards a higher valuation and higher chances of being. So it's this. The next one is this a pill, or is just a painkiller? So it's like or a vitamin. You take vitamins. You don't have any condition, but you just to keep up your health. But or like a pill is something that you have to take, and if, for instance, if to stay productive. So it's how you position yourself. Just one follow-up question. What about Uber? Is this a pill? Or is this a vitamin? Okay, Uber is what? It's a taxi service. It's a vitamin. You can survive without a taxi, can't you? Okay. Well, it's like if it is, there are like painkillers when you are experiencing pain, or as opposed to nice to haves. Competition. The more time you spend on researching your competitors, the easier it will be for you to pitch to an investor. You need to explore your market, do ample research about who are the dominant players in the market. So this scoring is like a checklist exercise. Now, sales channels. How, in principle, how you've described them. Do you have any partners? Partners is good. It's good to have partners. Now, the more partners you have, the better. The more you sort of connected or are thinking of getting connected with, because this is, if your partner is sort of well established, you can piggyback on that partner and use them as leverage. And if you look for alliances, look for someone to piggyback on, and this is certainly going to increase the value of your startup. Additional financing. It's good when you don't want any more financing. You are only ready to give up a certain proportion of your company. That's it. But normally you are planning for the following rounds. Like, it's good to have an angel investor just inject a certain amount of cash into. But if you are planning on, and if you disclose to investors you're going to go on other rounds within the next 12 months, because fundraising is actually very tricky, and it's founders normally put 3 months to 6 months into each round, and it causes the burnout. And if you're doing fundraising, that's all you can do. You're fully immersed in this, you're fully focused on fundraising, and this is a red flag to investors. If they go, okay, let's you go back to the drawing board if you want to go on this round, and then on the next round very soon, that it's like the investor could be of help to you. Good. If you are planning to increase the current pace, I'm going to increase my investment. But you'd better discuss this early on when you meet the investor the first time. You should ask the question: will you be prepared to do a second round? It's you need to get that sorted out, and then you then add up those values, and each has a weight, and that's how you compute your resulting score. Well, in principle, All these numbers are available online. I mean, the model itself. You just populate it with your own numbers, and you end up with the result. Now, the next model is a summation of risk factors model. So it's well, basically, then again, this is all based on assumptions, and you do not proceed to valuation until you've created your financial model, because when there's two worldviews, before and after your financial model. When you've done your financial model, it's a different world for you, and it's only after you've done that then you proceed to valuation, because this actually makes you do a lot of work, a lot of research about your competitors. You go and to Crunchbase and you retrieve a lot of data about your competitors, and your entire concept can change. Sometimes you go back to the drawing board about your product. Sometimes you turn around completely. So you do not proceed to valuation until the point when you are getting ready to do your fundraising, and it's when you created your pitch, when you know how to answer your investors' questions. So all these metrics, you will be able to assess them based on the prep work that you've put into your financial model. I understand that all these, they're just some spooky words to you. It's not until you've sat down to doing your own financial modeling. That's when those answers will come to your own questions. So I've done many webinars and masterclasses. It's always there is this initial apprehension or this misunderstanding. Like it's like eating an elephant one piece at a time. The same applies to financial modeling. You need to begin somewhere. You begin by basically thinking about your own sales strategy and your clients. Your post-revenue valuation is when you've made sales, and it's certainly so much easier case on so many levels. Maybe not operationally, but at least financially, in terms of making those calculations. Two methods. There is the discounted cash flows method and the venture capital method, and it's all based on your financial model, on your actual performance and your projections. Now, the only thing that you can argue about with investor is about your multiple, and I recommend benchmarking your own multiples against comparable startups. Like if you look at past M&A transactions or other exits, then you look up those deals and look at those multiples. Now, the method of discounted cash flows, it's actually very widely used by corporations. That is considered to be the golden standard approach, and in this case it's sales, then you discount those sales, and look, I'm not going to overwhelm you with all those spooky words and too much detail. My job here is to give you the basics for you to take on board and then work on your own project. And that it's not that it's not that the same model would apply to a SaaS project and a hardware project. They all have their own unique features. My job here is to tell you what's important. So it's how to pick your discount rate. Some pick the inflation rate. Somebody picks 10%. Then again, I suggest you do a fair amount of benchmarking and look at some industry statistics. There is no one size fits all kind of answer, but you certainly you may be fine with adopting 10%, but you need to look critically at your own project and whether your project can bear that discount rate. Well, if you are pitching to the US market, so you just take the inflation rate, and no one is going to ask any questions because the inflation rate is universally accepted to be sort of the general kind of average, and do not make your own life too difficult. Okay, a bank, an interest rate, bank interest rate. So it depends on. It's okay if this is the U.S. market. I'm okay with the inflation rate. Post valuation. So in this case, the planning horizon is 3 years, and you make calculations for that's okay. This is a post revenue valuation, which means that you've made sales and you have a previous period of periods. If you have your annual top line, so this is what you use to at the end of the day, you need to keep your model balanced between the past and the future, because you don't want to have it all in the future. Microphone. You have your actual numbers and you have your future projections. So the 3-year horizon is just sort of generally accepted timeline. It's not something very complex. It's just and you are expected to produce a financial model for 3 years. Now, if you have 3 years worth of actual sales data, then you expand your horizon to 6 years. Then look, we are talking about net earnings. That there was the question about. This is net profit for 3 years. Net profit. When you're making any projections, then if you just one example, okay, you are planning to raise funds now, and then your next round is scheduled for sometime in a year and a half. So post-money, pre-money valuation. So that depends on your investors. Well, some methods, some investors basically leave it to your own discretion. Some insist on the pre-money valuation. So it's when you've completed your valuation and you then create a table with the respective shares of each investor, and then any options, then you compute the number, the amount that you are seeking, and then how much you are giving up of your company, and are you prepared to give up that particular percentage? If not, so if you are prepared to give up a smaller share of your company, then that would determine the amount of capital that you would be likely to raise. But it's a different world depending on how much you give up. So if you have a basic idea of your pre-money valuation of say this much, many startups that I've calculated sometimes that it's when they go into this exercise, they emerge with the conclusion that, wait a minute, I will have to give up too much of my company. and it will become unfundable, and then the investor will go, look, if I go for 30%, then the next round will simply fail. I'll be just stuck with this startup, is what the investor will be thinking in that situation. I think that it is definitely below 20%. The smaller, the better, in terms of the share that you are prepared to give up. That now it's why grant funding is such a hot topic that you don't have to pay it back, and that's why it's all those safe and convertible notes and all those other instruments you don't, because then again you don't have a very good idea of how much you're worth. If you are expected to go up 20%, of what value, of how much, and there is this cap when a convertible note actually does convert into capital, and that trigger and the ceiling should be set at as a value as high as possible. If you haven't raised anything over the next period, then the investor wants to speed up the next round, because they will not be part of that next round for early stage investors. So it's like as they go $1.5 million, and then this is onerous on the startup, that because the startup don't want to see those bonds converted into capital at an early stage. They want it to occur at a much later stage. So I'm pretty much done with my presentation. If you have any questions, now is the time to ask them. It's about an initial agreement between two more co-owners. So it depends on where you are. If your jurisdiction is the US, it is one story. In Ukraine, it is very different. In Ukraine, early days startups, well, they normally exist as sole proprietorships. But you can sign a document, but it will not have much binding effect. So you need to seek professional legal advice. But until you have taken on an investor, it's okay. If it is a product that you created here, most startups exist as sole proprietorships initially. To create a limited liability company before you consider fundraising, people don't do it. But then again, when you are ready to start raising funds, then you need to make your choice of jurisdiction. In most cases, it's not going to be Ukraine. If we're talking about venture capitalists, they are not prepared to operate in Ukraine's legal environment in most cases. A venture investor is a professional investor who finance startups. In principle, the entire industry, so all startups are initially funded by venture capitalists, and there are also angel investors. Those are referred to as angels because they're ready to basically take you at face value and invest without doing much verification, but they are not professional investors. It's more of a hobby for them. It's more, and it may be like they may be connected to the business. It's either family, friends, and fools. Basically, those who are prepared to invest in a startup initially, and then all they are left with is just prayer. They just pray that it might succeed. Because if you show this model to a non-professional investor, they will go, "Why do it?" But when you begin moving towards sitting down with venture investors, spoiler alert, I'm going to talk to you about the package that you will need to engage with venture capitalists. And it's not just your past, your just basic idea. You've got to have your NPV number, something more tangible. So you need to begin acquiring the characteristic traits of a business. It's like a caterpillar is slowly beginning to turn into a butterfly, and And many venture funds that invest at an early stage, they don't mean that very early stage. If it is and you're still at the bare idea stage, then you go into incubators and you apply for grant funding. So it's just that the question is that they ask what is your MRR, and if you go $30,000, it's just that it's like it's somehow it's a magic number, and everyone expects to have at least $30,000 per month for them so the MRR, they don't really care about the earnings at this stage. It's just something that would serve as proof that somebody is willing to pay you for whatever it is you're doing. This means that your proof of concept has become, well, a money maker initially, that people are willing to pay. Anything else is sheer conjecture. It's just your assumptions, but if they're not materialized into anything tangible, the best proof of your startup is a paying client. This is what actually shows that your startup is viable. I think if what I'm catching is that he's talking about a project that was profitable but then became a loss maker. Does it make sense for an investor to invest in a loss-making project based on its past history and that it could get a rebound? But it's not very likely. It's if something like this happened, you need more research into why it happened, and throwing money at the problem may not solve the problem. You need to basically investigate this situation, why your earnings fell, and if you invest to bring earnings back, what is it exactly you're going to invest in? Because if you are prepared to start bringing things back, and then this would make for a more compelling case for an investor. But it's like, would you invest in a loss-making business simply because it was profitable once? But you need to always try and put yourselves in the shoes of an investor. Okay, imagine you have a big purse with money to burn, but you have a wide choice of startups to invest in that don't have that kind of toxic profile. So what is your secret sauce? And you've got to, in your case, in that company, we need to try and understand why you've lost profitability. The question is the choice of planning horizon is up to your break-even point or past that, that's with some more room to see profitability. But if it depends on how capital-intensive your project is, you need to show through your financial model how you're growing and how you are basically embracing that growth. But a convertible note stays convertible until the next round. I was speaking about the threshold at which it becomes convertible, because there's a startup that's raised one round and they have no clarity about when they're going to shop for a new round, but an investor wants to see returns. And well, it depends. It's sometimes, there have been cases of an investor simply recalling their investment. Microphone. I'm not a lawyer. What I'm my company operates in the European Union, and well, as soon as a startup begins looking for an investment, and it's in most cases will not be the market of Ukraine. Even if they start here, but then they scale up into the European Union, into the United States, and they shop for investors there. But I'm not aware of projects that get funded by venture capitalists here. But here, venture funds they suggest Warsaw, Cyprus, Estonia as their preferred choice of jurisdiction. So the money ends up in Ukraine eventually because the R&D team is based in Ukraine. But speaking about protecting the venture investor, that 99, not 100%, in 99% of cases, the company will not be domiciled in Ukraine. We're speaking about venture investment because Ukraine doesn't have the tools, almost no tools, for investor protection. And the judiciary is a very big pain, you know where. And this is not a sound legal environment for startups. Hopefully it will change one day. Your last slide, you had a multiple of 5, and your rate of return was 70%. It's like we met with a US-based algorithm. I'm an Amazon-based entrepreneur. I sell Amazon merchandise. So they go, if it is a multiple of 3, then we are looking at a 5x number. They don't really care. It's how much I make in monthly earnings. So what I would like to gain a deeper insight into what are some multiples. Maybe you're aware of any cases. I always recommend that we look at competitors. There's Crunchbase, which is a great asset, and it holds a lot of intelligence, and you can look at your competitors and how they've developed, and you can browse their multiples, and you can look at M&A transactions. There is dem room that it's actually quite expensive, but you can use it in trial mode. Your competitors, your access to information, and I've done mentorship at an accelerator program, and somebody asked me, can you reach out to clients to obtain inside information? I don't have a problem with that. To find out about competitive prices, and we are only creating a company when you're at the stage of... So it's fine to do a healthy espionage, in particular if you're targeting the US market or the British market. All those metrics are in the public domain. Multiples, and what really matters is that publicly available information is something you can fall back on to strengthen your negotiating position. And look, that's why it's called a negotiation. You can negotiate. There are things that your potential investors appreciate that you're not aware of. Your potential investor. It's only when you sit down to negotiate that you find out, and you will feel them. Can you put pressure on that particular investor? Try to meet with multiple investors, and this is how you are going to figure out how much you're worth. I've had clients just walking walking out on an investor. But look, we now they've done this exercise. They feel that we're so cool. Why give up a piece of a company? Your financial model is an useful exercise because it will enable you to figure out what you are really worth. So a question is slightly a digression. We're talking about startup, but many countries, in particular in the US, there's this Technoparks. Their job is to create a breeding ground for startups. So is it really worth it? Could a foreign investor potentially be interested in creating Technoparks in Ukraine? To invest money in a Technopark is also a business operation. It is supposed to break even, but if people leaving or creating a startup in the US, you grow them here, and then they move to another country, be it the US or Estonia. What's the point of investing in that initial growth here? But what could incentivize the government to promote Technoparks is what could be the benefit that the government could potentially derive from promoting Technoparks in Ukraine. Look, the biggest problem in Ukraine is not that there are no Technoparks, is that Ukraine does not have a sound legal environment. If it were to be created, that it will emerge of its own accord. If you look at Poland, for example, it's the government extends a lot of grant funding. It's doing so much to encourage an influx of investment, to encourage IT professionals to move to Poland and companies to move to. If we were to copycat that experience, we would be in a much better shape. I really welcome the startup fund. It's good to be able to apply for a grant, and this is like a magic wand for any startup, and it's early days because this will get them prepared for this. They will not end up giving up a large share of the company, eventually seeing their startup erode into something unfundable. The more the merrier, but until and unless the legal environment becomes sound enough to open up in Ukraine. I know guys who've set up their startup in Ukraine. They're not thinking of moving to the US, but their company is incorporated under Estonian law or in Poland, not because they don't love Ukraine, but they are incapable of raising financing. So it's a Polish fund will only invest in a Polish entity. You may not have to do it until they are prepared to sign a check, but it's just that everyone wants to protect their investment. But even if an investment wanted to invest in Ukraine, there are so many pitfalls. And that is already risky by definition. A Technopark is a great idea, so is an incubator and accelerator. But those will eventually end up being incorporated as companies under Estonian law or Polish law. Can I talk to you a little more about the formula? This is a really very painful question, and I've heard 5 wildly varying interpretations, and I'm trying to average out those answers. Look, it's pretty simple. It's a lot more simple than you think. You adopt one method that you like best, and you don't worry about the rest. That's my question, because I'm actually loving yours, and it's the one that I like. Just a small bit of advertising. We have created financial modeling templates, marketplace, and a SaaS one. So if you follow this link, or you can add me on LinkedIn, and I'll share a reference and of those models that we charge for. You have those, and you can calculate anything you want. I think that A financial model is very critical to a startup, in particular when you're approaching your seed round. You need it. But this is not your top priority. Your top priority is your product. Anything else is secondary. You've got to devote as little time as possible on creating documentation for investors. You need to have the bare minimum, but while you are designing your product, you're bound to collect all that information anyway. So do not try and basically pull a hair out of a hat and create long pitch decks. My big friend Denis Dolgopol, he always presents in front of a white screen with two numbers, and everyone was like devouring his results. And he goes, do not waste time on this pomp and circumstance. If your product is selling, if you have at least initial sales, that's it. You don't need anything else. You can rely on tangible facts and figures. All you need is more of the same. You need this strong footing to sit down with an investor. Otherwise, you are begging. You go, look, I've come up with a brilliant idea, give me money. Yours is, by definition, a weak negotiating position. Yes, you've got to strengthen it. Yes, you still based on a lot of conjecture and assumptions. You haven't hit your first 1 million in sales, but you have something to show for it. You have some strong team. Your team matters a lot. It actually, especially in your early days, it's something that is a big driver of value. If you have a strong team, your investor, if they fall in love with your team, if they sit down with the founder and they like them, they're a bright individual, and they will help you bring your idea to fruition. Always engage with investors who understand your product or your business. When you're doing research to shortlist investors, you do not pick those who invest in anything or everything. Invest in, basically pick those who invest in your particular industry. You will have a good professional, they have good networking capacity, they know somebody who could be brought on as partners, and they could not only help you with funding, but they could help you with everything else. So can you cite any examples of how much to give up to an investor? So, okay, you put a value on your startup. You work out the shares of all co-founders. Okay, if you hold 51% and the other person holds 49%. Okay, you give up, say, 10% to an investor. Okay, you've done. You've crunched them. Is there any range from and to? So how much we're ready to give up to an investor in exchange for the money? You need your company valuation. Okay, you have your valuation. Okay, let's assume your business is worth $1 million. You need to raise 100,000. Then you have to give up 10%. You have to work out for yourself that you proceed from your valuation. Okay, if you're worth $1 million and the investor agrees, and you want 100K, then you give up 10%. Why? Because 100K is 10%. Okay, now it's getting late. That's why. If you're worth $1 million, but you want to raise 10 million, then how? It doesn't compute in my head, at least. You've got to be worth at least 15 or 20 to make that happen. Well, the whole point of valuation is to measure your own ambition. is it of this world or of somewhere else? This is where valuation really comes in very handy. Just to follow up on the previous question, is that on the importance of researching your own market and I've done this. I found 3 venture funds that were potentially eligible. Is it ethical to try and find people on social media networks, to researchers and other people, with maybe up to 1,000 applications that a venture fund gets in the mailbox? Is it ethical even to try and find those individuals on social media? Look, you should identify any startups they've invested in and try and engage with the founders of those startups and ask for a recommendation, for an introduction. That is the more sensible path. And you will learn about those startups in the process. You will get to meet the founders and you'll go, look, we are selling to the same target audience. Can we solicit an introduction? Yes, yes. Why is it late? The value, if the value is 1 million and we want to raise 100K, then why 10%? It's 9%. Yes, you caught me. Yeah, you caught me. Mathematically, you're correct. Yes. Have you exhausted your questions? Okay. Feel free to find me on LinkedIn and ask me more questions, and I'll be happy to help.